You know, it's funny. We spend so much time chasing the next big tech explosion or the newest AI startup. But sometimes the biggest opportunities are rolling right past us on the highway, specifically in those massive silver trucks you see everywhere.
You're talking about Sysco Corporation, aren't you? Ticker symbol SYY.
Exactly. It's the definition of a boring business. Food distribution. But looking at the data we have today, boring might just be the most exciting play in the market right now.
I completely agree. It's rare to see a utility-like staple stock suddenly wake up and start acting like a momentum play. But that is exactly what's happening with Sysco. We are looking at a report generated on February 21st, 2026, and the signals are flashing across the board.
It really is interesting. I mean, usually when we talk about food distributors, we're talking about safety, dividends, slow growth. But looking at the U.S. Stock Picker podcast channel, name U.S. Stock Picker Podcast Analysis, the setup here looks different. It looks aggressive.
It is aggressive, but it's grounded in reality. The analysis identifies what they call a triple threat setup. This is when the fundamentals, the technicals, and the market sentiment all align perfectly. It's not just one thing working. It's everything firing at once.
Let's break that down, because triple threat sounds great, but I want to know what's under the hood. Let's start with the news. Why is everyone suddenly paying attention to Sysco?
The catalyst here is undeniable. In mid-February 2026, Sysco management raised their fiscal year 2026 EPS guidance. That is the North Star for this stock right now. When a company of this size tells you, hey, we're going to be more profitable than we thought, the market listens. That announcement alone triggered a nearly 10 surge in the stock price.
And that's not just inflation, right? Because that's always the worry with food. That revenue is up just because eggs cost more.
Precisely. The data shows volume gains. That means they are actually moving more boxes, not just charging more for them. That's a massive distinction. Following that guidance raise, we saw major institutional players jump in. Wells Fargo hiked their price target from $92 all the way to $100. Guggenheim pushed theirs to $95.
So the smart money is buying the story.
They aren't just buying the story, they are buying the stock. We saw filings showing Candrium SYY increasing their stake by over 40%. That is a huge vote of confidence. It tells us that professional portfolio managers are rotating into Sysco as a defensive hedge that still offers growth.
Okay, so the sentiment is strong, but let's play devil's advocate for a second. The stock is trading around $90. Is it expensive?
That's the beauty of this setup. Despite the recent rally, it is still fundamentally undervalued. The discounted cash flow models suggest a fair value of around $115. So even at $90, you're looking at a potential 27% upside. It's a classic quality at a discount play.
That's a significant gap. Usually, when you see a discount that deep, there's something wrong with the business.
Well, there are risks, which we should touch on. The bears will point to the debt. Sysco has a debt-to-equity ratio of over 7.0. That is high. And their free cash flow growth recently took a dip. But, and this is a big but, in the world of food distribution, high leverage is common. It's sustainable as long as they can service that debt, which they can. Their return on equity is sitting at a massive 88.7%.
That is an incredible number. It sounds like management is just very efficient at squeezing profit out of their assets.
Exactly. They are also innovating. They launched this Homegrown by Sysco pilot program. It targets the farm-to-table, locally sourced market. That's a high-margin niche. So they aren't just relying on delivering frozen fries. They are chasing the artisan trends where the profit margins are fatter.
So we have strong fundamentals and great news sentiment. Let's talk about the chart. I'm looking at the technical analysis here, and I see the phrase blue sky breakout. That sounds optimistic.
It is. The stock has cleared its 50-day and 200-day moving averages. It's in a confirmed primary uptrend. We call this a golden cross environment. Essentially, the path of least resistance is up. However, we need to be careful here.
I was going to ask, when a stock jumps 10% on news, usually it gets a little overheated, right?
Spot on. The Relative Strength Index, or RSI, is currently sitting at 75.46. For our listeners, anything above 70 is considered overbought.
So, if I'm hearing you correctly, the trend is up, but buying right this second might be a little painful?
Exactly. The U.S. Stock Picker Podcast channel name, U.S. Stock Picker Podcast Report, gives a very specific signal here. For the near term, meaning the next 1 to 5 days, the signal is actually wait.
Wait? But you just said it's a buy.
It's a swing trade buy, but with patience. Because the RSI is so hot, we are likely to see a minor pullback or some sideways trading to cool things off. The smart move isn't to chase the price at 90 to 13s. The smart move is to act like a sniper. You want to wait for a dip.
Okay, I like that analogy. So, we are looking for a specific entry point. We aren't just throwing money at the market order.
No, never chase a vertical line. The analysis suggests looking for a pullback to the $89.00 to $89.50 range. That's where the risk to reward ratio shifts in your favor.
That makes sense. Let the excitement die down just a fraction, then get on board. What kind of time frame are we looking at for this trade to play out?
This is a swing trade setup, so we are looking at a 3 to 15-day horizon. The momentum is strong enough that we don't want to hold this forever, though you could for the dividend. But for this specific trade, we are targeting that move toward the analyst targets.
And what if we are wrong? I mean, the market can be fickle. What if that debt becomes an issue, or the market just rolls over?
Risk management is key. The report identifies a clear line in the sand. If the price closes below $87.30, the thesis is broken. That breaks the recent structural support and the 10-day moving average. If it hits $87.30, you get out.
Got it. So we have a floor. $87.30 is the eject button.
And on the upside, we have clear targets. First target is $95, which aligns with the Guggenheim forecast. If it clears that, we are looking at $98 to $100, matching the Wells Fargo target.
It really does seem like a sweet spot. You have the defensive safety of a company that feeds the country, combined with the aggressive momentum of a breakout stock.
It's rare. Usually, you have to choose between safety and growth. Sysco is currently offering both. The math, meaning the discounted cash flow, says it's worth $115. The chart says it's going up. When those two agree, the probability of a successful trade is very high.
It's a compelling case. It reminds me that sometimes the best investments aren't the ones making headlines on tech blogs, but the ones putting dinner on the table.
Absolutely. The invisible giant is waking up.
All right, let's wrap this up with a clear game plan for our listeners. We've covered a lot of ground, but let's distill this into the actionable steps based on the report.
Let's do it. Here is the summary for Sysco Corporation SYY.
First, let's look at the news sentiment.
Sentiment is strong positive. We have raised earnings guidance, a 10% stock surge, and major analyst upgrades. The market is happy.
And the fundamentals?
Strong positive. The stock is undervalued. It trades around $90, but has a fair value of $115. It's a high-quality business trading at a discount.
Now, the million-dollar question. When do we start investing?
Do not buy immediately at the market open. The signal is to wait for a minor pullback. We are looking for a cooling off of the RSI.
And what is the specific price point to start investing at?
You want to set your buy orders in the $8,900 to $89.50 range. This gives you a better entry than the current $90.10.
Once we are in, when do we leave the market?
You leave when the price hits our swing targets. We are looking to scale out, take some profit at $95 and exit the rest as it approaches $98 to $100.
Finally, and most importantly, how do we protect ourselves? What is the price point to leave the market to mitigate risk?
Your hard stop loss is $87.30. If the stock closes below that level, the trend is broken, and you exit the position to protect your capital.
Crystal clear. As always, the market gives opportunities to those who are patient and prepared.
That's right. Plan the trade and trade the plan.
Thanks for tuning in, everyone. We'll catch you on the next one.
Goodbye.
Disclaimer. The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. SEO clickbait video. Title: Sysco Stock Alert. Why Analysts Just Raised Targets to $100. Buy now?